Right now, in 2026, a retired schoolteacher in Ohio is paying $14,000 a year in income taxes she does not legally have to pay. Not because she did anything wrong, not because her accountant made a mistake, because nobody told her that 3 specific accounts exist where her money grows completely outside of what the IRS can tax. Not tax-deferred, not tax-reduced, not we'll deal with this later. Tax-free, permanently. And 2 of the 3 have no limit at all on how much benefit they can generate for you over time. The IRS doesn't send a letter when you qualify for something new. Your accountant isn't paid to find strategies that reduce their own workload next year. So what I'm going to show you are 3 accounts the tax code already allows, already names, and has allowed for decades that most retirees only discover after they've spent years paying taxes they never owed. Before I go further, let me be precise because I'm not going to oversell this to you. When I say invisible, I mean invisible to the one thing that actually matters, your tax bill. The IRS cannot count a single dollar of this money as taxable income. It never shows up on the line that decides what you owe. That's what invisible means here. Now here's the number most people never sit down and work out. If you retire at 65 with $500,000 in a traditional 401k and pull $40,000 a year to live on, every dollar of that is taxable income. At a 22% federal rate, that's $8,800 a year before your state takes anything. Over a 20-year retirement, that's $176,000 sent to the IRS out of money you already earned and are now supposed to be living on. These 3 accounts don't shave that number down. They change which of your dollars the IRS is allowed to count in the first place. A deduction lowers the amount you're taxed on. This removes the dollar from the conversation entirely. Those are completely different things, and there's an order to them, which matters. The first works best if you're still working, even part-time. The second is the one advisors mention once and move past. It has an advantage no other account in the entire tax code has. And the third, which I'm saving for last, isn't like the other 2 at all, and it has no contribution limit whatsoever. If I explained that one first, the first 2 wouldn't seem important. So stay for it. One question before I start, and I'd like your answer in the comments right now. Are you currently paying income tax on money you're pulling from a 401k or traditional IRA? Just type yes or no, because the number of people who type yes is going to tell me exactly how many of you are hearing this for the first time. Type it now while I keep going. And subscribe if this is useful. The IRS adjusts these limits and thresholds every single year, and this channel tracks them. People who follow along find out before the limits change. Everyone else finds out when it's too late to act for that tax year. Account number 1. Account number 1 is the Roth IRA. And before you click away because you've heard of it, the way most people use a Roth and the way it actually works at full strength are 2 different things. Here's the basic mechanic. A traditional IRA or 401k takes your money before the IRS touches it, lets it grow, then taxes every dollar on the way out. A Roth takes money the IRS has already taxed, lets it grow, and never taxes it again. Not the growth, not the withdrawal, not when your children inherit it. Put $7,000 in this year and let it grow to $70,000 over 20 years, and the IRS sees 0 taxable income when you take that $70,000 out. $63,000 of growth, completely invisible. The 2026 limit is $7,000 a year, or $8,000 if you're 50 or older. That sounds small, but $7,000 a year starting at 45 in a basic broad market index fund averaging 7% is roughly $340,000 by 70. Every dollar of it comes out with 0 federal income tax. Now here's where most people stop thinking about the Roth. And it's a mistake, because the real power is in 2 things almost nobody mentions. First, your Social Security. Most people don't know their Social Security can be taxed at all, but up to 85% of it can be once. Your combined income, that's your other income plus half your Social Security, crosses $34,000 single or $44,000 married. Every dollar you pull from a traditional 401k pushes that number up. Every dollar you pull from a Roth does not count toward it at all. Second, your Medicare premiums. Medicare looks at your income from 2 years ago, and above certain levels, it charges a surcharge called IRMAA on your Part B and Part D. In 2026, that starts at roughly $109,000 for a single person. A retiree pulling $50,000 a year from a traditional IRA can land above that line and pay more for Medicare every single month. The same retiree pulling from a Roth keeps that income off the calculation entirely. So a Roth withdrawal does 3 things at once. It isn't taxed, it doesn't tax your Social Security, and it doesn't raise your Medicare bill. Now the income limit and the legal way around it. In 2026, direct Roth contributions phase out starting around $150,000 single and roughly $236,000 married filing jointly. Above that, you can't contribute directly, but there's a completely legal workaround called the backdoor Roth. You open a traditional IRA, make a non-deductible contribution after tax money, no deduction taken, and then immediately convert it to a Roth. Because you move quickly, there's essentially no gain to tax, so the whole amount lands in the Roth and grows tax-free from there. This isn't a loophole. It's been explicitly allowed since 2010, and Congress has had multiple chances to close it and chosen not to. Your action step: open a Roth IRA at Fidelity, Schwab, or Vanguard. Under the income limit, contribute directly. Over it, open a traditional IRA alongside. Make a non-deductible contribution, convert immediately, and mark it as non-deductible on IRS, Form 8606 when you file. That form is what stops you being taxed twice on the same money later. Account number 2 is the health savings account. And I'll be direct. If you think of an HSA as a way to pay doctor bills with pre-tax money, you're using about 1/3 of what it does. It's the only triple tax advantaged account in the entire U.S. tax code. 3 layers, and most people burn 2 of them without realizing. Layer 1, money goes in tax-free. Through payroll, it avoids federal income tax, state income tax in most states, and Social Security and Medicare payroll taxes, a combined saving of 20 to 40% of every dollar, depending on your bracket and state. Layer 2, it grows tax-free. Invested, it compounds every year without the IRS taking a cut of the gains. Layer 3, it comes out tax-free for qualified medical expenses. No income tax on the withdrawal at all. Compare that. A traditional 401k gives you layers 1 and 2, then taxes you on the way out. A Roth gives you 2 and 3, but not 1. The HSA is the only account that gives all 3 at once. The catch: you must be enrolled in a high-deductible health plan. In 2026, that means a minimum deductible around $1,650 individual or $3,300 family. The 2026 contribution limits are roughly $4,400 individual and $8,750 family, plus a $1,000 catch-up if you're 55 or older. Now the strategy almost nobody uses. Most people run money in and straight back out for doctor visits. Instead, contribute the maximum, invest the entire balance, pay your current medical bills out of pocket if you can afford to, and let the HSA grow untouched. Here's why that works. And this is the part people don't know. There is no IRS deadline to reimburse yourself. Pay a $400 bill out of pocket today, keep the receipt, and you can reimburse yourself from your HSA 5 years from now, or 30. As long as the expense happened after the account was opened, there's no time limit, which means by retirement, you're sitting on years of accumulated receipts, a tax-free cash reserve you can draw on at any moment that the IRS never sees as income. And after 65, it changes again. Non-medical withdrawals before 65 are taxed plus a 20% penalty. After 65, the penalty disappears entirely. Non-medical withdrawals are simply taxed like a traditional IRA. So after 65, your HSA is either completely tax-free for medical costs or an ordinary retirement account for anything else. It's the only account that does both. The number that puts this in perspective: the average couple retiring today is projected to spend over $300,000 on health care in retirement, not counting long-term care. Every dollar of that paid from an HSA, zero income tax. Every dollar paid from a traditional IRA, taxed at your ordinary rate. At 22%, that's a $66,000 difference on the exact same medical bills. Your action step: confirm your plan qualifies as a high-deductible plan for 2026. Open an HSA with a provider that lets you invest the balance. Fidelity, Lively, and Health Equity all do. Not a cash-only account. Contribute the maximum and start keeping a digital record of every out-of-pocket medical expense from the day the account opens. Every receipt, every copay. Here's the problem the first two still don't solve. Between them, you're sheltering maybe $16,000 or $17,000 a year. What about the rest? The $50,000, the $100,000, the $200,000 sitting in a regular brokerage account. Taxed on dividends every year, taxed on gains every time you sell. Account number 3 handles that. And it's different because it isn't an account you open at all. It's a rule that already exists in the tax code. It's called the 0% long-term capital gains bracket. Everyone knows about the 15% rate on investment profits. Almost nobody knows there's a rate underneath it. A rate of 0. Not deferred, not reduced, 0. Here are the exact 2026 numbers. If your taxable income after your standard deduction stays at or below $49,450 single or $98,900 married filing jointly, your long-term capital gains are taxed at 0%. And retirees are in the perfect position for this. Think about who has low taxable income but owns appreciated investments. It's you. Especially in those early retirement years, after the paycheck stops but before Social Security and required withdrawals fill your income back up. That's when there's room underneath the ceiling. Picture a married couple, both 66, living on about $40,000 from a pension and some dividends. After their standard deduction, they're far below that $98,900 ceiling, tens of thousands of dollars of room. So they sell stock they've held for years with a $60,000 gain inside it. That gain stacks on their low income, still lands under the ceiling, and they pay the IRS zero federal tax on all $60,000 of profit, simply because they knew where the line was. Now the move that turns this into a repeatable strategy: after you sell, you can buy the exact same investment back the very next day. The wash sale rule that makes you wait 30 days applies only to losses, not to gains. So you sell, rebuy immediately, and your cost basis resets to the new higher price. All that appreciation is locked in permanently at 0%, and your next sale starts counting from the higher number. That's called tax gain harvesting, and you can do it again in every low-income year. Now the boundaries, because I promised you accuracy. The gain stacks on top of your other income. So the real question is how much room is left under the ceiling after your Social Security, pension, and any withdrawals. Realizing a big gain also raises your income, which can make more of your Social Security taxable or trigger an IRMAA surcharge 2 years later. So don't blow past the line chasing this. This is the federal rate. Your state may still tax the gain, and the investment must be held longer than a year to qualify. None of those are reasons to skip it. They're reasons to check your numbers each fall while you can still act. Your action step. Before year end in any low-income year, estimate your taxable income, subtract your standard deduction, and measure the gap to that ceiling. That gap is the dollar amount of long-term gains you can take tax-free. Sell up to it. Buy back the next day if you want to keep the position. And if you're not sure where you'll land, a fee-only advisor or CPA can project it in an afternoon for far less than the tax would cost you. Here's what all three have in common. None are tricks, and none are loopholes waiting to be closed. The Roth IRA has been law since 1998, the HSA since 2003. And the 0% bracket is written into the tax code at Section 1H, with the limits reset by the IRS every year. These aren't new. They're just strategies the financial industry has no strong incentive to walk you through, because money protected in a tax-free account isn't generating fees somewhere else. The Roth removes your growth from the IRS permanently and shields both your Social Security and your Medicare premiums. The HSA is the only triple tax-free account there is. Used as an investment account rather than a spending account, it becomes a six-figure reserve for the biggest expense most retirees face, and the 0% bracket lets you take real investment profit and pay nothing at all. In any year, you stay under the line. Share this with anyone still putting every dollar into a traditional 401k or a taxable brokerage account, believing that's the only option. One conversation about these three before retirement is worth more than any strategy attempted after the money's already gone. Subscribe, send this to that specific person today, and I'll see you in the next one.